Hello, and welcome to another episode of the Innovators Investors podcast. I'm your host, Kristian Marquez, founder and CEO of FinStrat Management. Super excited today because with us we have Itamar Novik, founder and general partner at Recursive Ventures. Itamar, welcome to the show.
Thanks for having me, Christian. Really appreciate you bringing me into the show and excited to chat here and also reach out to your audience. So thank you for having me.
Our pleasure. And so with that, great starting place. Would love to hear about your journey and how you ended up starting Recursive.
Yeah, absolutely. So I've been in startups for my entire career, which is almost 25 years now. Starting off in Israel and then continuing here in the US. And I've been on all sides of the table. So I'm a serial entrepreneur and executive. I took my last company, Life 360, public, first in the ASX and now in the NASDAQ. It's traded over $3 billion market cap. I was also an early employee in a series of startups that have been successful before that. So I've been through a few exits myself as a founder and executive. And then I've also been investing since 2010. I've actually invested in 158 companies over the last 14 years, both as a Series A, Series B investor and as a super early stage seed, pre-seed stage investor. And I've been very fortunate to be part of the journey of 6 unicorns so far. I help my founders get from 0 to 1 and sort of build their companies at the earliest stages. And that's really where my passion is. And have been investing very heavily in data, AI, and financial services companies over the years.
And so I have to imagine that having been an operator yourself, it has a tremendous influence on your approach to venture capital investing. Would love to hear your perspective.
Yeah, I'm a little bit old school in that sense, where I think that obviously there's great venture capitalists who haven't been, part of an operating team of a startup before. We know there's great people out there who um, can do a great job helping founders. But I'm more old school in the sense that I believe that uh, most great VCs have actually been founders and operators before, and have worked through, the trenches and kind of built a company, faced the same challenges that their, you know, customers, if you will, founders have faced, and are able to help them when S hits the fan, if you will. So I have a similar background and a similar advantage where I've gone through a lot of this stuff. I've raised over $400 million myself at every stage of building a company, right? I've dealt with hiring and firing and, uncertainty and ups and downs of a startup ride. And I think people in my position are potentially best suited to help founders as they go through their journeys in their companies.
And I've been a founder myself, but also work with a number of early stage companies. I mean, in simplest terms, it's not a bed of roses. A lot of things can and will go wrong, and knowing what to do and what not to do, obviously, is extremely invaluable. So with that, I would love to hear Recursive's investment thesis and how you go about identifying high potential companies.
Yeah, absolutely. But actually, you hit on something that's really interesting. That's a small segue that I like. And there's no single sort of recipe for success, right? A pattern for success. When you look at different successful startups, each one kind of found their own way to success. But there's actually clear patterns on failing, which is why I have a series of content around anti-patterns in startups, things that you shouldn't do that could potentially kill your business. So it's actually the opposite. It's hard to chart the path to success, but it's easy to figure out what are the things that could really kind of screw up your company. And that's part of what we offer at Recursive Ventures, which is, our focus in terms of investment, kind of turning to your question, is really these days focused on data and AI and how startups can leverage AI to disrupt antiquated business services, specifically around financial services, insurance, and property management, prop tech, right? Where we think there is a huge opportunity to leverage this new emerging technology to really significantly increase productivity. Like think about all those people working on spreadsheets, right? And doing a bunch of manual sort of white collar work that we know agents can do very well, AI agents can do very well on one hand, and in other cases, potentially even replace humans in the loop and actually do the work that humans do as efficiently as humans or as precisely as humans do it, but potentially even better, right? Over time as the technology improves. So that's really the kind of sectors that attract us the most. We're pre-seed in early seed investors at Recursive Ventures, typically writing between $500,000 to $1 million checks very early on. So often, could be two gals and a dog in a garage that we would invest in, just with, great founders, a vision, and a big market that they're pursuing. And sometimes it's a little bit more later where you see small teams of like maybe 5 to 10 people. They're already up and running. They've got a beta. They've got, some customers and early traction. And we would come early at those stages, kind of help them scale up and get to the next level, let's say all the way up to the Series A.
Okay, and so with that, clear picture on the type of tech and sector that you're focused on. You also mentioned the team, but in Recursive's investment thesis, what roles does the founder or founders play in your experience with success?
Oh, it's massive. I mean, and the majority of the deals that we do these days are really with proven serial entrepreneurs that we've known for a while, and we know they've got, an excellent track record of sort of delivering, right? Which is key. So, I mean, founder quality and sort of the fit that founders have to solve the problem, and domain expertise are really key in our world in making an investment decision. And when we think about the founding team, we think about the founding team in several different dimensions. One is we think about completeness, right? Do we have all the right sort of key DNA in the company to be successful? Often there's a business founder, and sometimes there's a technical founder, and maybe there's a go-to-market expert, like marketing, sales, that could really help boost the business. So team completeness, having the right DNA is sort of one thing. The second thing that we care about, because we're part of the VC ecosystem, is what we call backability. So we want to make sure we're backing founders that are able to actually raise, additional capital, go through the motions, kind of scale the company in a fast way, which, often with VC-backed startups, one of the ways to scale up the company is obviously to, raise more capital and accelerate growth, right? Momentum acceleration is really important in these types of startups. So we want founders that are backable. And the last thing we want to kind of, obviously I mentioned that, but just like digging in a little bit more, is a proven track record of execution and being able to deliver and, enabling customer satisfaction. So we're really looking at operational teams that know what they're doing, that know how to build software, deliver software, and make their customers happy.
And so with that, what extent does Recursive get involved to make sure that they're not only avoiding the common pitfalls that you see, but nurturing opportunities for success depending on where they're operating?
Yeah, so similar to other VC firms, we have a pretty significant advisory team. We have over 20 advisors, including go-to-market experts when it comes to sales and marketing and product-led growth. We've got experts in all those areas that we kind of match with our companies to help them think through some of the challenges that they have. But I think where we really shine as a firm, and what we really are, maybe sort of our superpower, is helping our companies raise subsequent capital.
Okay.
So I've helped over 50 companies actually raise their Series A hands-on. We have a full program around, here's our ability deck, here's like the right narrative, KPIs, back channeling those to make sure that the company is actually ready to go out fundraising. And then obviously we know quite a large number of investors here in Silicon Valley and beyond. So we would introduce our companies to some of those follow-on investors to kind of facilitate institutional seed and Series A rounds. And one of the most important things in these companies at this early stage is just surviving, right? Like raising enough capital to stay in the game, because it's often unknown how much time it would take to get the product market fit. And what people don't talk about a lot in ventures, sometimes you don't necessarily get the product market fit. The market comes to you. And we just saw that with AI, where like, the market has changed, like the trend has changed a lot. And suddenly a bunch of companies that were on the sidelines have been brought to brought forward to light. And that's when, you have an opportunity because you survived long enough to reap the benefits of being early when a new trend is out there. So getting capital and having enough capital to survive until you're able to scale up is key, and that's what we specialize in.
And so for founders out there who are just getting exposed to raising capital from venture capital for the first time, what advice would you give them?
Well, first of all, not every company should be venture backed. So before you even think about including VCs on your cap table, you should think long and hard on whether you want, and this business should be a VC-backed business. It should be, it should have certain characteristics of being a scalable startup where you can put capital into play and that you can show probably sort of a terminal state of sort of a very high margin business, which often happens in software businesses, not just in software businesses, but software businesses have that characteristics because software inherently is something that you can potentially write once and then, distribute to 1,000 customers. So the marginal cost of goods sold, if you will, of serving the N+1 customer trends to zero, which means that eventually at scale, you would have an 80+%, margin profile for the business. And that obviously spells a very high valuation. So you want to have some constellation where you can create a very, very high value business because you have high operating margin. At the same time, you want to create a business that can also grow very fast because momentum and speed, velocity is actually key for startup success. So maybe today, because you're early on, you're smaller, it's kind of hard to see how you build momentum, but you want to go into a big enough market that's ready to adopt your product so that you can really scale really quickly when, things really jive together. And I mean, there's other characteristics, but if you don't really fit those characteristics, you should think long and hard on whether you should have venture capital to begin with, because you might get to a point where you're misaligned with your VCs on, what this thing looks like and where it should go. And that's not what you want to have. You want to have capital partners that are really aligned with your vision of where this company is going. So bottom line, venture capital is not for everybody. Think long and hard on whether you should have venture capital in your company. That's one. But to answer the second piece of your question, if you do believe that you have the right profile to be venture backed, then I think you should really educate yourself first, if you don't have experience fundraising, on what VCs are looking for in terms of what are the key criteria that matters to them. Have a good understanding of things like TAM, total addressable market, and be able to kind of analyze that for yourself first as a founder. Like, is this a big enough market that I should pursue VCs, right? Do I have the right team members in place, right? And I'd say the last thing that's probably really important is understanding what stage you're at and which VCs are really a right fit for the stage that you're at. One of the biggest mistakes I see founders do is, they're very early, like say pre-seed and seed, and then they go in and talk to, sort of a Series A, Series B VC, and these guys end up sucking a lot of time from them because they kind of want to know and learn about the business, but they're actually not a good fit to finance the business at this stage. And obviously, the founders spend a lot of time trying to do that, but it's not actually converting into dollars in the bank. So focusing on the right VCs for the stage that you're at is very, very critical to focus your energy and time on the right, sort of leads.
And I'd love to hear your experience over the years. Do you find that founders are beginning to better appreciate that venture capital have limited partners of their own that they need to generate a return for, and that influences decisions?
I think founders, especially more experienced founders, know and understand how the venture capital business works to some degree. I think the honest truth is they don't care. Like, it's not their problem to have. But I think to a certain degree, it is, right? They should care, especially when you're thinking about raising capital at later stages. And some of those VCs become your board members. And obviously, they have their interests and their LPs' interests in mind. And that could create conflicts down the road with the founders. VCs and founders are not always 100% aligned, right? So being ahead of the curve in the sense of like understanding where VCs are coming from is very helpful for founders, especially at later stages, especially when trying to effectively manage your board.
Yeah, and I think you also brought up another great point. It's just time. There's only so much time in a day between having to run the business and talk to potential investors that if you can better understand who you're talking to ahead of time, the process will benefit it from it. So that said, you identify a great founding team. You love the company profile. What advice do you provide companies between balancing rapid growth, but also viable business practices?
Yeah,
scale?
I think it really depends on the type of business. There are businesses where, you know, just give you an example of one of my latest investments. It's a company called Symphony, and they offer all the legal services that you need to start a startup or an SMB, right? Instead of having to go to a big law firm, they have an agent that can put all those documents together for you, give you legal advice, and mostly something that's a templated in a simple service, but they do it at 20% of the cost. Like 80% is kind of what it would cost you to do it with, with a big law firm. And that's an example of a business where you just want to go, go, go. I mean, this is such a great product. Every founder that you talk with about this product, and you tell them, hey, you can have the same set of documents, legal documents that you need to work through at an 80% discount. We'd be jumping on rooftops and like, I want this. And obviously there's going to be a lot of competition. So you just want to potentially grow as quickly as possible, take in capital, and accelerate the business. And you also have product market fit in this business, which is an interesting example. Other types of businesses might not have product market fit, and they need to prove that the basic unit economics, right, the business fundamentals around their business actually work, right? Whether it's they have high cost, or they can accelerate as quickly, or they haven't really found exactly why their customer would buy them and how much they would pay. In those instances, you want to go back to the fundamentals of making sure that you get the right unit economics, you understand exactly what the value proposition for your customer is, and you figure out whether the pricing and sort of business model even works the way you want it to work with those customers. That's where I would emphasize taking the time to make sure you're doing things right, and throwing another 50 customers into the mix in the pipeline is not always the best solution when you don't have like a well cemented model in place, right? So take the time, figure out how to build this right, versus situations where it's like go, go, go. You just need to move as quickly as you can. First mover advantage, try to try to grab as much of the market. So that's a very lengthy answer to it really depends. But at some point, you got to figure out your business fundamentals, because otherwise you're not going to be able to mature to, let's say, a public business, right? Like a public company, right? So it's just a question of when do you figure that out?
Well, and on that path, credit to you. This may be the first time that I heard that someone's playbook includes things not to do. And so I'd love to hear, is there a common reoccurring mistake that you've seen that founders have a potential or a tendency to make, and that you'd encourage them to really be conscious of avoiding?
Well, the honest truth is that there are a lot, and it's also situation dependent. But I mean, I would just speak to something a little bit more contrarian, which is a lot of people talk about overfunding for startups, like raising too much capital, it you have a valuation, and then sort of flying too close to the sun, right? Kind of thing. I would say I also see founders do the opposite mistake of not raising enough capital, not having enough margin, not having enough room for error. And startup journeys are, these ups and downs where you're going to make mistakes, and things are potentially always going to take more time than you thought it would take, right? So I often encourage founders to raise as much as they can when they've got something going for them. And especially at the stages that I operate in, often you're just selling the dream, right? There's a dream and there's a great idea and a great founding team that's pursuing it. And sometimes they are more measured in a sense of like, oh, maybe we just raise 500,000, then we prove some more points. And I think raising capital on the dream is probably one of the easiest rounds you're ever going to have, right? To raise as a founder. So I often encourage my founders to raise as much as they possibly can, bring into the system to give them enough runway to kind of help find that product market fit.
I think I may know the answer, but when you're evaluating financials, what are the typical green and red flags that you look for?
Well, look, I don't spend that time evaluating financials because most of the companies that I invest in barely have any revenue, if at all.
Okay.
But I think with later stage companies, and we do syndicates, later stage syndicates, and even like pre-IPO companies from time to time. I think really what we're looking for as the company scales up is increasingly getting closer to more of the sort of analysis that a portfolio manager or a public equity analyst would do in terms of, again, what is the a terminal operating margin profile of the business. Where are the moats of the business, right? Can you grab more market share? Is it more, subject to competition? The strength of the business model or the IP that's underpinning the business, right, becomes even more important in that scale. Um, and in an even more acute way, like what is the real size of the market? Like, can this company produce, $500 million of revenue at terminal state, or can it produce $10 billion of revenue, right? To kind of, because if it can't go big enough that the music would stop at some point. So the later stage the company is, the more emphasis we would put on understanding those financial characteristics. But for pre-seed stage companies, I mean, honestly, we don't even look at the income statement most of the time because there's not much to see there.
Okay. Um, and then, but as far as runway, what's your ideal amount of time that you'd like to see?
Yeah, so I encourage my founders to try to take money for at least 24, if not 36 months of runway, assuming that there is no significant increase in revenue. So like flat revenue. And I think that kind of adds up to what I talked about before, where you want to, I mean, your job as a CEO fundraising is de-risking the business by having this capital injection, right? So that's why I often push people to raise more, to give them more time to figure things out, because there's a lot of unknowns very early in the business. You just don't know how much time things would take, right? So 24 minimum, 36 preferable if you can.
Okay. Um, my sense is sometimes, perhaps not the early stage ecosystem, but the world writ large doesn't appreciate the role that venture capital plays in making capital available to companies. That said, world is constantly changing. I would love to get your perspective on what you think, or what role the VC industry is going to play in the years ahead in shaping the early stage landscape.
Yeah, that's a good question. I think we're in a pivotal time in the land of venture capital. I think AI is really changing the game. I'm I'm not sure that the amount of capital that's now available in this asset class is actually appropriate to the size of the opportunity. I think we're looking at an industry that's on the brink of shrinking in a significant way. Uh, First of all, there's been too much capital that was pumped into this asset class, especially during the ZERP sort of heydays of 2020, 2021, 2022, and some of that capital has to get out of the system. But the other thing that's happening at the same time with AI is that the efficiency, the productivity gains that we're seeing on things like engineering with co-pilots, SDRs being run with sales like the AI tools and so on and so forth, can actually get companies to a state where they can do much more with much less. And then that begs the question of why do you need a $5 billion or whatever size it is recent fund, right? Like if you have companies that are just so efficient, then they don't need this type of capital injection to get big and get very profitable. So I think we are looking at a future where there's going to be less funds, less capital, but actually also significantly smaller funds that are going to be successful. Ones like mine who, write the first check so you can leave your cushy job at DeepMind Google to start your next AI company. But then once you're off to the races, maybe you don't need as much capital to actually build a big business. And I think that poses a significant challenge for sort of Series A and later stage VCs that are out there.
It's fascinating, kind of, we can't help but wonder what impact that has on future exits, and time to reach them, especially for companies that may be thinking about IPO. I mean, does that make the case that they take longer or that there are less of them?
I think actually what we're seeing now with AI is that things are accelerating. So AI companies are actually growing faster in revenue compared to SaaS companies, which I would say SaaS was kind of the last big sort of trend in tech, which obviously still continues. But I think things are actually going to happen faster. We're going to have bigger companies faster than we had before. And I think they're going to potentially be, again, sort of much more efficient because they're AI first and they're also operating with all those like cutting edge AI tools. And that would create a very lucrative profile, including for companies in this category that want to go public.
Yeah, and it probably makes the case of looking at capital efficiency as a metric for success. Um, and perhaps it's a hallmark or, um, green flag for companies that have a potential to really hit unicorn status sooner rather than later.
Yeah.
Itamar, it's been a great podcast, but like all good things, unfortunately, they have to come to an end. Before we wrap up, last question. Love to know what's been the most challenging and rewarding things about being a venture capital investor.
Yeah, well, let's start with the most rewarding. The most rewarding thing is, helping our founders work through the good times and the hard times. Just being a sounding board, and I personally love being the person that gets the call when things get bad and complicated, and you need to kind of jump in and help the founders think through it. So that's been very rewarding. The fact that we've been able to help those companies scale. Um, the more, I'd say challenging thing is just, the environment that we're operating in. A lot of funds are zombie funds. You don't even know who has capital and who doesn't. And obviously raising capital, which is part of what VCs have to do, has been really challenging in the last few years. We're very fortunate. We're about to announce our new fund, Recursive Ventures 3, which is, a very significant fund for us. But it's definitely been a challenging sort of period, uh, mostly for smaller emerging VCs. And I think that's a very important part of the ecosystem, which I hope LPs are going to spend more time in, with emerging managers versus kind of flock to the big funds, which obviously have a big role in the industry. But the smaller funds who kind of seed the companies very early are super critical to keep our sort of innovation train, steaming forward.
Congratulations on fund number three. And it sounds like you're at a sweet spot too, having a track record, being able to attract that capital away from some of the larger firms. That's fantastic. Congratulations.
Thank you. Thank you so much. Yeah, we're very excited and looking forward to what I believe would be probably the most impactful, influential wave of innovation that we've ever seen, maybe even bigger than the personal computer. And that is, AI as we know it today. It's really a game changer. We're excited about it.
100% agreed. And we're coming up on year two of OpenAI's release of ChatGPT. Probably consensus that we're just getting started.
Oh, yeah.
Itamar, if there are any founders, co-investors, limited partners who'd like to get a hold of you, how can they find you?
Well, the best way, unfortunately, is get an introduction for somebody that knows me. I don't really respond to cold calls because honestly, I get too many of them. So, especially if you know founders in my very extensive portfolio, again, over 150 companies, or people that I've worked with in the past, that would be the best way to get a hold of me. I have two venture partners, so kind of same goes for them, Konstantin Ottner and Chris Halls. If you know somebody that knows them and you can kind of ping them through that third party, that would be ideal.
And for our audience, particularly our founders, I and ask you to appreciate that when you have a successful fund, you're going to get a lot of interest and a lot of outreach. And like we were talking about earlier, time is a premium. And so totally makes sense. You got to be wise as to how you use it. Itamar, thank you again. I genuinely appreciate your time and your perspective. This has been a fantastic podcast. With that, thank you everybody for joining us for another episode of the Innovators Investors podcast. I'm your host, Kristian Marquez, founder and CEO of FinStrat Management. Thank you, Itamar.
Everybody for joining us. Appreciate it.